Hello and welcome to this session. This is Farhad, in which we would look at internal control over the expenditure and acquisition cycle. Now, in the prior session, what I did is went over the expenditure and acquisition cycle step by step, showing you the different documents, the process, how it works, the various accounts that are involved. In this session, we would look at internal control in general and how do we test internal control as we go through the cycle. So first of all, what are internal control? Maybe we don't know what they are. Those are policies and procedures designed to minimize errors and prevent fraud. Because remember, when you are making a purchase and making a payment, you want to make sure that the purchase is authorized, the purchase is properly recorded, the purchase is paid for the right amount, so on and so forth. So the key control are typically implemented to make sure all purchases are authorized. There's segregation of duties. We are recording the transaction and we are doing independent review of all our bills. And the payment is authorized and it is for the right amount. Now, for each one of these four, I'm going to go over each one separately, expanding a little bit on them. How do we make sure that the purchase is authorized for different assets? Same thing, what should be segregated? How do we record and do an independent review and payment of authorization? Then at the end, we would look at certain techniques that you could use, not techniques, certain methods that you could use to test the internal control. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great, you are looking for some additional help and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
Starting with authorization of purchases. What does that mean? It means before a company makes a purchase, and I went through an example in the prior session, buying 100 tablet. You need to have the proper authorizations. All purchases must be properly authorized to make sure they align with the company's objective and avoid any unnecessary or, most importantly, inappropriate expenses. What happened when you see fraud in the local paper, if you look at it, most of the time it's a vendor fraud where someone at the company keeps submitting bills and the company keep paying those bills. Those are inappropriate expenses. So we want to make sure that whatever we're buying first, it's properly authorized. We don't make a payment unless we see a record of that proper authorization, unless we have a receiving report. Then we make the payment. So authorization requirement now varies depending on what we are buying, the value of the transaction. But let's just take a look at some examples. For example, companies might buy fixed asset like capital expenditure, building, warehouses, trucks, vehicles. Well, those large expenditure like machinery may require approval from the board of directors. So as an auditor, if you're auditing the company and you know any property, plant, and equipment purchase would need board approval, if that's the company's bylaws or if that's the company's rules, you have to check that authorization. Do they have the proper authorization to make that purchase for that fixed asset? So this is what we mean by proper authorization. A purchase cannot be made unless we have the proper authorization. Now, for routine purchases like office supplies or low value items, maybe we only need the managerial approval, or below a certain amount, maybe as an employee we can do it on our own. Each company is different. Then We might have an automated recording system. Inventory management system may automatically reorder essential supplies such as raw material when stock level drop below a predefined threshold. Now, in some companies, you have the system programmed. Once we reach a certain level for raw material that we need for manufacturing our product, the system automatically process this request, so we don't need managerial approval. It's being done automatically. Now, under those circumstances, the auditor would still have to do what? Audit, make sure the system is working properly. But this will be kind of an IT audit. They will test the system, but that's a different story. Nevertheless, authorization, the authorization control is in effect here. So effective authorization to make sure every purchase serve a legitimate business purpose and comply with the budgetary constraint, because that's the whole purpose of the authorization. So this is the first step in stopping the company from making unauthorized purchases. Now, the second step, the second key control, which is it applies to all cycles, is segregation of duties. What is segregation of duties? It means make sure you have more than one person involved in the transaction, and that involvement works as a checks and balances between the two. So assigning different individual to key tasks within the cycle to reduce the risk of fraud or errors, to make sure one person is checking on the work of others. Now, for example, the purchasing department may approve the orders, but they should not receive the goods. So you can approve it, but you cannot receive it, because if you can approve it and receive it, and it might disappear. In other words, you can buy something, you can receive it. What if you take it home and nobody knows about the approval or the receiving? So if you approve it, you cannot receive it. Employee who handle physical inventory should not maintain accounting record. Well, for that matter, employees handling practically any asset should not have access to the accounting record. In other words, access means they can change the accounting record. Why? Because if you have access to both, you can steal with one hand and cover with the other hand. So this segregation prevents any single individual from having control over the entire transaction process, reducing opportunities for manipulation. So segregation of duties, it works in all cycles, and in the acquisition and payment cycle is definitely very, very useful. The other thing we want to make sure we do is record transaction of time. Transactions should be recorded promptly to ensure that financial records are up to date. This process typically involves matching critical documents, and we talked about those in the prior session: the purchase order, the receiving report, and the vendor invoice. Those are the three-way matching: purchase order, receiving report, and vendor invoice. Once we have them, then we should, theoretically, we should have a legitimate purchase, because to have a purchase order, it must have been approved. Then we receive the product, then we receive the bill. If we have those three, it's better if you have even the purchase requisition right from the beginning. Who's ordering this and for what purpose? It's even better. But usually the purchase requisition information is included with the purchase order, because when we buy something, we have to justify why we are buying it. Okay. For example, if the company ordered 100 tablets, which that's what we did in the prior session, the receiving report should confirm the delivery of the same quantity. The vendor invoice must also match this information, and discrepancies are flagged by automated systems, and independent review ensure corrective actions are taken. Now, if you are using automated system, they match the receiving report with the purchase order with the quantities. If there's any discrepancies, it will flag it immediately. Now let's take a look at this multiple choice question from farhatlectures.com. Which of the following is inappropriate? So notice, not appropriate for establishing effective internal control. So we're giving 4 statements about the expenditure cycle, and which one is not appropriate. The purchasing department sends a copy. Well, we've not told about which cycle, but since we know we're talking about the cycle, but let's take a look at the answer choices. The purchasing department sends a copy of each issued purchase order to the receiving report. Should the purchasing department send a copy of each issued order to the receiving report? And the answer is yes, because the receiving department, they want to know what to expect. Now, that purchase order should be blind. You don't tell them exactly what to expect, but we should send them to expect something. So that's appropriate. A is out. So this is easy. When it's appropriate, take it out. The accounting record transfer responsibility for the goods each time they are moved. Yes, you should record transfer responsibility of the goods from the receiving department to raw material, from raw material to work in process, from work in process to finished goods, from finished goods to inventory, from inventory until it's sold. Yes, the accounting record should do that. That's an appropriate internal control, keeping track of goods. The accounting department approves the purchase requisition and prepares the receiving report. Well, should the accounting department do that? Absolutely not. The purchase requisition should be approved by the person with the proper authority, depending on what they are buying, whether it needs the managerial approval or whether it needs the board of directors approval. But that's definitely not the accounting department. And definitely the accounting department don't receive the goods, because the accounting department, they have access to the record. They should not have access to any goods. I would say C is inappropriate, but let's look at a copy of the receiving report is sent to the accounts payable. Yes, the receiving report, they will tell the accounts payable what they received, because the accounts payable need this receiving report for the three-way match to make sure we received what we ordered, what we are billed for. That's proper. So C is not the proper internal control. What should you do? Go to Farhat Lectures, look at additional resources, multiple choice resources that's going to help you, whether you are an accounting student, CPA candidate. Invest in yourself. That's the best investment you can make.